every time that we've seen a substantial weakening of the dollar, we actually see re-dollarization. If the dollar becomes weaker against your domestic currency, you can now borrow more dollars, and that old debt that you have is easier to pay off.
Did you ever think it was realistic that, of course, we're going to have 250% tariffs against China and that was never going to come off? We'd never do trade with them again? Or was it always that was going to be sort of that negotiation point, the anchoring, if you will, to allow us to come back off of that into some negotiation?
We've offshored our industrial base. And so if you're going to impose massive tariffs, that transition period could definitely cause a very severe recession. Gold and Bitcoin have worked to, hedge against debasement, against inflation for decades. And of course, gold has been theorized to be suppressed. That's been suppressed by central banks and by bullion banks for the last 20, 30 years. But that suppression is finally coming to an end.
Do you think we end 2025 higher than we are now? Gold, S&P 500, and Bitcoin?
Yes, to all three. The reason why is because
All right, PB. You've been warning that Trump's tariffs could be the final nail in the dollar's coffin as the world's reserve currency. You've talked a lot about Bitcoin potentially taking its place. Over what time frame do you see these types of things happening?
That's a difficult question to answer. And a lot of people have posed that same question to me, especially when I've given talks in person like I did just a few weeks ago in Vancouver, Canada. But it really depends on, the geopolitical chess match that all of these different players play, right? What are the moves that they're going to make? The fundamental issue that is at, question here, right, is the actual structure of the global monetary system, which is basically subject to something called Triffin's dilemma. And this dilemma basically implies that the U.S. has to export dollars in order to fund the global economy or to provide enough liquidity to the global economy to allow trade to occur. And now demand for those dollars comes from many different sources, from the euro-dollar market, from international trade and settlement, from foreign exchange and currency reserves for foreign central banks, as well as obviously the petrodollar system. And so all of this external dollar demand essentially needs to be supplied with dollar liquidity, and this means the U.S. has to choose whether they're going to supply that liquidity or not. Now, if they don't do that, then we have a global recession like 2008 or even before in the 1990s if the U.S. decides to not fund global liquidity enough. But if we do decide to fund that global liquidity, we print too many dollars, as Triffin said, under our gold reserve ratio, and that causes us to break the gold peg, which we obviously eventually did. So our system switched from a gold-based reserve system to what I would call a treasury-based reserve system, right? The dollar is the reserve currency, but the treasury is now the reserve asset. Now, this kind of quasi-balance was able to hang for as long as the treasury bond remains money good in real terms, right? If you're earning real returns on your treasury bonds and you're a foreign central banker, it makes sense for you to hold these things. But the minute that the Fed decides to hike rates in a very, very rapid fashion to defeat inflation like they did in 2022, you start to see negative real returns on your treasury bonds. And not only that, like you said earlier, the tariffs that Trump has announced and the escalating war, essentially economic war that has been playing out over the month of April, has basically meant that the stability and structure of this monetary system has now been called into question. And it's pretty clear. If you look at global central banks on net, they're funding much, much less of global of treasury issuance than they were in 2008 to 2015. And if you look at even private entities, they're not buying at the same pace that they were in years prior. The marginal funder for U.S. debt, therefore, has to eventually become the Fed, which is what I've said before in Dollar Endgame, right? Like, we'll have to do QE again on a larger scale. And so all of this means that I think the tariffs and Trump's response to other countries instituting retaliatory tariffs means that the equity markets, the bond markets, everything starts to retrace very, very rapidly. And that's why Trump had to basically recant a lot of the insane tariff rates that he was proposing of like 200, 300% on China and other countries.
Perfect. Framed it up very, very well. All right. I took lots of notes, lots of places for us to dig in on that. Thank you for setting the stage for that. So let's dig into some of the pieces of this. So let's talk about Triffin's dilemma, which, to the point that you made, ended in 1971, basically, right? Nixon took us off the gold standard, and now we're in this free-floating fiat era treasury system, or whatever you want to call it. And you talked about the need for the U.S. to continue to supply dollar liquidity. But you also mentioned like the euro dollars. So the euro dollars are outside of the U.S.'s control, right? So there is dollar liquidity being created that the Fed is not doing. We also have now stable coins, U.S. dollar stable coins, which are sort of another euro dollar standard, I would say. We could argue that. And both of those things could provide dollar liquidity to the world without the Fed necessarily having to do that up front, right? Or no?
Yes and no, right? If you study the Eurodollar system and if you've read Jeff Snyder's work, you'll come to understand that the Eurodollar system is essentially synthetic dollars. And same with, right, USDT, stablecoins, these kinds of things, because unless they show proof of reserves, unless we know for a fact that they are backed one-to-one by real dollars, we can, basically assume that this functions similarly to the Eurodollar system, which is basically entirely synthetic dollars. Now, those synthetic Eurodollars, right, they are backed by a portion of real U.S. dollar reserves held at correspondent banks in the United States. So it's not to say that like the system is complete fabrication, but if let's say 20% of them are held as U.S. dollars and the system grows substantially every single year, then that obviously increases real dollar demand, which is why the U.S. has to export dollars, i.e. they have to do the opposite of the trade balance, which means import goods and create a trade deficit in order to sustain the global economy. And I've seen people on Twitter like Parker Lewis and others who've claimed, this isn't how the system works. We don't actually need to export dollars. That's all a lie. And to them, I would show them the chart of the U.S. Central Bank liquidity swap lines that the Fed opened post-2008 and post-2020 in the aftermath of, obviously, the Great Financial Crisis and COVID-19. And those charts are pretty telling because you see very quickly how the Fed has to offer hundreds of billions of dollars in liquidity swaps, basically meaning a U.S. dollar for their domestic currency swap, to all these regional banks. And why? Because they need their own banks, right? All these central banks, correspondent banks, these smaller commercials need liquidity. They need real U.S. dollars to back up the euro dollar, basically like fake dollars that they've created.
Right. And just to put some numbers on that for the audience, we have the real problem is approximately $300 trillion of U.S. dollar denominated debt and only about $100 trillion of dollars. Right. And so we need more dollars to pay off the dollar denominated debt that's going to demand the dollars to pay that off. The U.S. dollar stablecoins, I can understand you saying that because in order to get the stablecoin, you have to have a dollar. You have to pledge a dollar to get a dollar back. So it's somewhat of like a one for one, if you will. The euro dollar market is not backed by anything other than the confidence in the banking system overall. But I guess that's a whole nother issue that we can get into. But you did speak about the Fed doing less Treasury issuance, how it's gone down. And so the Fed has been less involved, but yet U.S. Treasuries are still being sold. Now, we do know that if you look at like central banks' net purchases, they've been going up in gold and down in U.S. Treasuries. But it's almost like at the same time, the demand has stayed there. So it just seems like you said it depends on how bad this like system degrades, if you will, right? But it seems like it's been holding pretty good, all things considered.
Yeah, I would say it has been, but the main reason it's been holding together, so to speak, is because of actions behind the scenes that the central bankers and the monetary authorities have been doing. So just like what you described right there, right, the Fed has been tapering off their treasury supply, right, essentially doing QT. If you actually look behind the hood or below the hood, you see that all things aren't really equal in terms of prior quantitative tightening cycles. The Fed in this cycle did not sell on net anything past 10 years, meaning during the QE run up, they bought a ton of bills, they bought a ton of notes, they bought a ton of bonds, 10-year, 20-year, and 30-year bonds. And then during the taper, and I have a chart for this, and I can send it to you if you want to display it on the screen now, where when they started the taper, everything past 10 years, they actually did not sell any. In fact, they kept increasing their holdings of the 10-year, 20-year, and 30-year bonds while they decreased their holdings of bills and notes. And so this meant that on the surface, while their overall size of their balance sheet continued to decrease, the actual holdings of bonds remained high and continued to climb. And so that meant that, in my opinion, right, the Fed understood that they could not lay off this amount of bonds without causing yields to completely blow out. And so they did this intelligent, behind the scenes, you could call it stealth liquidity, where while they were tapering, they just ensured that they didn't sell any of the long-term bonds and in fact bought more to provide support for the bond market. And the reason why this is important, of course, is because of duration risk, right? Banks can much more easily hedge against a short duration bond than a long duration bond, just because a long duration bond has much more interest rate risk than a bill, for example.
Right. Yeah, I definitely saw that this week. We could see some of the reports on that. Now, that's the dilemma. That's sort of where we're at, and we can just frame it up with the rock of the hard place, right? Do we keep printing? Do we keep manipulating? And if so, like how long can that last? But maybe that leads us into the next big topic, which is the tariffs that we have so far. A couple of things that you mentioned. One was that, we had these insane tariffs, 145% against China, and then 245% against China and things like that. And you mentioned, I forget the exact word you used, but, Trump backtracking or coming off of that, right? A lot of the mainstream media headlines that you would see are like he's caving or things like that. But from an analyst perspective, I mean, did you ever think it was realistic that, of course, we're going to have 250% tariffs against China and that was never going to come off and we'd never do trade with them again? Or was it always that was going to be sort of that negotiation point, the anchoring, if you will, to allow us to come back off of that into some negotiation?
I think it was basically like a retaliatory, almost like show of force, right? It was a chicken game, if you will, of two cars racing at each other.
Right.
And Trump thought that he held a much, much stronger hand than he actually does. Because, again, the issue comes when you realize the implications of Triffin's dilemma, as well as, obviously, the results of it. The implication is that we need to send out dollars on net to the global economy to fund, basically, global trade. But the other implication, obviously, is that we've offshored our industrial base. And so if you're going to impose massive tariffs in the desire to move us back to an autarkic economy, basically an economy that's self-sufficient, that doesn't need to have maybe much import-export, that can basically provide everything that it needs just by itself, it's going to take a lot of time to reshore industrial bases, to retrain American workers. And then there's obviously like the cost implications for high-end manufacturing, iPhones, consumer electronics, cars, et cetera. And that transition period could definitely cause a very severe recession. But even more importantly than that, obviously it would cause an unwind of a lot of these carry trade and pro-liquidity effects that have taken place with regards to this Triffin's dilemma that's been playing out for the last 30, 50 years. And so that means that equity markets and bond markets are going to fall, substantially. And I don't think Trump was ready for that amount of economic pain. And I'm not saying that, whether it's right or wrong that we should move back towards a more self-sufficient and more reshored industrial economy, or if we should let our manufacturers move overseas and basically ship away all of our jobs. But there's always trade-offs, right? This is a world of nuance. There's never anything simple. And so if you want to do that path, you're going to incur a lot of economic pain. And so, yeah, I think that 245% was just almost like a bloviating show move, if you will, that was just meant to scare people. But in reality, that kind of thing would not hold long-term if you want to basically retain our global monetary system as it is.
And I don't think that was ever the plan, right? I mean, obviously he wrote the book Art of the Deal, which is anchoring, right? You go high, you settle low. So it opens the door for negotiations. I think a couple things in that as well that I think about is that, Stephen Moran, who's Trump's economic advisor, wrote a paper before Trump became president and basically coined the term Mar-A-Lago Accords. And so he sort of laid out this playbook that seems to be sort of what the Trump administration is following down now, this playbook into this Mar-a-Lago Accords. Maybe not exactly. I think maybe he's moved it more aggressively than was laid out in the paper. But I think also in that, so the 245% was much more aggressive. There's been a lot of talk about this potential game of chicken. I think, as you called it, I would agree with that framing. Like this game of chicken, like who could go longer, China or the U.S.? Realistically, neither of us could survive without each other. I mean, it'd be very rough if we did, right? And I thought, man, I mean, China welded people in their friggin' houses during the pandemic. Like they can go through a lot of pain. Like the U.S. isn't going to put up with that, right? As of like yesterday and today, though, it looks like China is like caving like super fast, right? They already switched to easing. They're like begging for a meeting. It's looking like they want a deal pretty quickly. I don't know if you've been paying attention to that.
Yeah, no, and I'm not surprised that they do. While the CCP can maintain basically like monetary and economic harsh conditions much longer than the U.S. can, it does not behoove them to do that at this current juncture, right? We've seen a Chinese economy for the last 2 or 3 years that's been in basically recession or a complete contraction due to
Yeah.
the real estate and banking sectors starting to fall from their massive shadow real estate bubble that's been imploding. We saw the bankruptcy of Country Garden and Evergrande and several other large developers, as well as defaults of major property developers all across China and their failure to pay dollar bonds, as well as onshore yuan bonds. And so the Chinese economy essentially has kind of reached this, I think, severe inflection point where they now need to choose if they're going to go forward with a path of deflation and let their real estate bubble basically burst in slow motion, essentially like 2008, or are they going to reflate the bubble and print the yuan and let the yuan devalue? And that's a difficult decision to make because either way, obviously, there's economic pain, but the winners and losers are different in each scenario. Right. If you choose the deflationary path, then obviously the equity holders and the bond holders are going to get wiped out. But you might be able to retain that yuan 7.3 to the dollar peg for a lot longer. And then if you go the other way, obviously you're going to see a blowout in your currency. But on the plus side, the exports become much more competitive. So China's been trying to show this strong face, right? This poker face. But again, if you look at, even the data, like I was looking at this yesterday, ever since 2022, they've stopped publishing most of their economic data publicly. If you look at youth unemployment, you look at factory orders, you look at new home sales and new home leases in China, all of the figures just won't be reported anymore by their version of the BLS. And so that tells me that things are pretty bad there right now. They just don't want the U.S. to know because obviously that would weaken their hand.
Yeah. Yeah, but it is a game of chicken. The way I see it is back to these Mar-A-Lago Accords was like, obviously put pressure on China. And I think there's, even in the Biden administration, was sort of this stance on China trying to put them back in their place. I think it's probably more from the intelligence community than just the Biden or Trump administration. But, Biden is the one that took away their ability to get microchips, for example, right? Advanced microchips, right, to limit their technology. And then started the CHIPS Act to start bringing onshoring some of that back. And when you think about that, tariffs are really about like more strategic moves, right? So it's like the U.S. doesn't need to make T-shirts and sneakers here. Like we gave those jobs up a long time ago, but it's like there are strategic things that we should be doing here, like, rare earth elements, having steel and copper so we could actually make things. And so I think there's like things that are strategic. It was never about bringing all the jobs back. It's like, what are the jobs that we need here? And let's just bring those back. We don't need to grow mangoes or coconuts. Like we can let other people do those things as well. And that seems to be happening at a pretty breakneck speed. As a matter of fact, if you saw the latest GDP numbers that came out, right, we had a negative print, but that was adjusted for a 41% increase surge in imports. But when you looked at the investments that were going on in the U.S., Trump announced $8 trillion of investments going on in the United States. It looks like we're going into some sort of like a reindustrialization that we haven't seen since like the 1940s almost.
Yeah, I would hope so, right? Because again, the negative effects, right, the knock-on effects of the offshoring of our industrial base is pretty substantial. It's pretty sad to see as well. Like in the Rust Belt states, one of the leading causes for death now is opioid addiction.
Yeah, terrible.
And depression and basically economic malaise is now kind of common young men, especially in those areas. And so when you destroy the ability of especially a large section of the middle class to make money and to provide for themselves, and you offshore that to foreign countries where they just do it cheaper and they still don't treat their workers well, obviously, right, in Southeast Asia, that just demoralizes the people and it obviously impacts the local economies, very, very severely. And so I think reindustrialization obviously should happen. But the question is, of course, like you said, what things should we bring back? And I think high technology, things that are critical to defense, lithium, copper, cadmium, things that are needed for battery and EV production, obviously. But like you said, agricultural products, certain consumer goods, we don't necessarily need to produce those here. So I think it's a balancing act. The problem with the tariffs as they're constructed now is that Trump, came out guns blazing with this tariff policy, thinking that essentially the U.S. was invulnerable, and then very quickly saw the market start to retrace, right? We saw the 20-year and the 30-year bond hit 5% within like a week, and credit spreads start to blow out in early April. And that signaled to him quickly that things were not going to go as smoothly as he had hoped. And so he started announcing basically exclusions. So he said, okay, we're going to apply tariffs except for iPhone, manufacturing, and except for automotive manufacturers, and except for, X, Y, and Z industries that need to have their cheap goods in order to produce cheap finished goods here in the U.S. The issue with that is that
I want to take a break real quick and just say that there's only so much you can learn through videos. Yeah, build your knowledge, build your skills, but you need to build your relationships. Relationships plus skills equals money. So come build your relationships and your knowledge at the Bitcoin Conference, May 27th through 29th in Las Vegas. I'm going to be there speaking for the 4th year in a row, and lots of other people way bigger than me. Entertainment, politics, media, finance, you name it, they'll be there. So come check it out. Save some money with my code Mark Moss, or I'll put a link down below. If you use my code to save some money, I'm going to do a private meetup just for you and some of my friends. So let me know. Use that code, save some money, send me a message, and we'll get you in the private meetup, and I hope to see you in Las Vegas.
This excludes small businesses, right? So small businesses won't be able to benefit from those exemptions that the large businesses are able to. And so that means that small businesses, if these tariffs are held in place as they're currently structured, the small businesses are going to be damaged quite significantly by the tariffs. And, that's where I think Trump needs to make some readjustments in his overall tariff policy to make sure that small businesses and small business owners, especially small manufacturers of end goods, don't get walloped by these things.
Yeah. Now, part of the Mar-A-Lago Accords, and even the name sort of spells it out, Accords, kind of rhyming the Plaza Accords of 1985. Very similar to also, what was done probably in 1944. So we have these periods of time, these historical moments where the global monetary system sort of gets realigned. So, obviously 1944, Bretton Woods Agreement, the whole world agreed. 1985. And those moments were like really getting the world to sort of agree to peg back to the U.S. dollar to allow the U.S. dollar to devalue. And that appears to be the same sort of goal of these type of accords, the Mar-A-Lago Accords, is getting the U.S. to sort of repeg back to the U.S. dollar and allow the dollar to devalue as well. That's the way that it seems to be right now. Part of that is realigning trade. So if we can get about 40% of global trade to be aligned to the U.S. dollar, we can keep the U.S. currency as sort of this, like, I think he wants to keep it about 60%. Right now we're about 59% of global trade. Then we can allow the U.S. to sort of have this coordinated devaluation. That's what I'm picking up. What do you think the ultimate goal of this is?
No, I absolutely think that you're right on the money with that. If you look at statements from, Besant, even Lutnick, right, as well as that paper that you mentioned, which I've read excerpts from, they do seem to be basically in agreement on weakening the dollar substantially. And the weakening dollar thing is actually a very intelligent strategy if you look at it from a geopolitical standpoint. The way that the system is structured is very counterintuitive, right? Because again, most of us would think that, and especially gold bugs would go out and claim that a weaker dollar means that gold is going to rip, the dollar is going to collapse, Dixie to 30, and Peter Schiff will be vindicated in the end, right? We can all throw a party with Mike Maloney and Peter Schiff in their warehouse. But if you look at the fundamental reality, again, of how the Eurodollar system works, of how the global monetary system works, that's not the case. I wrote a paper about this back in mid-April, but every time that we've seen a substantial weakening of the dollar, we actually see re-dollarization. So that means, if the dollar becomes weaker and you're a foreign, let's say, you're a consumer goods manufacturer in Pakistan. You owe dollar debt already via the euro-dollar system, right? If the dollar becomes weaker against your domestic currency, you can now borrow more dollars, and that old debt that you have is easier to pay off. So that means on net, the whole system actually starts to increase their borrowing of US dollar and US denominated debt. And so that means obviously that the system becomes even more reliant on the dollar over time with a weaker, comparatively weaker dollar. And so de-dollarization is not when the dollar's falling. In this case, that's re-dollarization. And a spike in the dollar is actually the, rush for liquidity that all these corporates and countries and banks are doing in order to fund their dollar debt. So a higher Dixie is actually emblematic of a breakdown of the global monetary system, not a lower one. And so that's why we saw obviously a very high Dixie in the 1985 Plaza Accords. That's why they had to devalue, because they had to reset the global monetary system and allow enough liquidity to flow out to settle all these dollar-denominated debts. And so, Brent Johnson's been writing about this for a long time as well, right? This lower dollar actually strengthens the milkshake, and it extends the lifetime of the dollar's dominance in the global monetary system.
Yeah, when you look at the Dixie dollar index compared to a basket of other top currencies, we're nowhere near the top where we were in the 1985 Plaza Accords. But I was just looking at a chart from the BIS of the U.S. dollar's relative strength. So it's like an adjusted matrix, and we're like well above historical levels in strength. So when you look at it from that perspective, but even if you look at it from the Dixie, I mean, maybe a more historical number might be 85 or 90. I mean, which if you look at it from that perspective, if you think maybe the goal is to devalue the dollar, would it revert to the mean? What is the mean? Is that 85 or 90? Is that a 10, 15% drop from here? And then what does that mean? How do you think about that math or that mechanic?
Sure. Yeah, you're right. Very long-term Dixie averages is 85 to 87, up to 90. So a 10 to 15% drop from here is basically bringing us back to baseline. And like I said, that means that that weaker dollar will help to re-stabilize, let's say, the euro-dollar market and to provide liquidity for all these banks. But more importantly, obviously, it will help these other countries who need to earn dollars and to essentially hoard those dollars as foreign exchange reserves for future monetary crisis, like the Japanese have been doing with their yen interventions, or even the BOE or the ECB may have to do in the future to defend the euro or the pound. And a higher dollar is basically restricting all of those goals. Now, a weaker dollar will impact, obviously, tourism for Americans. It'll be harder for us to go abroad and buy goods and services if we're going and traveling. But overall, it's a net benefit for the global monetary system as it is.
So that seems to be perfectly in line with this plan, because what Trump wants is more manufacturing in the U.S., less exports. And so if we have a weaker dollar, that's exactly what it does. It makes us more competitive on our exports, and it makes it harder for people to import into the United States.
Exactly. And if you can switch, remember, again, they still need to provide dollars. So if you can switch the dollar funding line from just exports and trade for goods, which is just a quid pro quo transaction where I give you dollars and you give me a bunch of Chinese electronics or Taiwanese semiconductors, right? If you switch that from a, let's say like trade-based arrangement to a financial arrangement, where instead of saying, hey, I'm going to be, giving you a bunch of dollars for your manufactured goods, I'm going to swap a bunch of dollars for your, own currency reserves, that allows the system to reindustrialize, I guess, much better than it would if you were stuck on that first mode. And so what they're trying to do is this kind of game of geopolitical chess, where they're trying to figure out how to manage their supposed mandate of reshoring the American industrial base and solving the problems that the populists have basically proclaimed to be plaguing America, as well as working with the global monetary system as it works today, right? Not allowing a global monetary crisis to develop under their watch.
Let's just say that switching the entire global monetary system is not a smooth. There's all types of unintended consequences that will happen throughout that. It can't be a smooth process. We could certainly argue for and against the case that Trump moved too fast or was too aggressive. But I would say, like, zooming out, I don't know if maybe you retweeted it or I saw somewhere online, but oh no, it wasn't you, it was somebody else. But they were just saying, like, after Powell's announcement today, that like he's a legend. Like, I mean, he seemingly might have pulled off a soft landing, which nobody thought was possible. China's coming around to negotiation. Looks like a deal with India is done. The dollar devalues a little bit. The world gets what they want. We bring some manufacturing back to the U.S. I mean, I kind of see a path here, with unintended consequences all throughout. I'm just kind of bullish. What's your view?
Yeah, I would broadly, agree with that statement, although I would give some caveats, right? So obviously, after that first kind of, mayhem with Liberation Day / Liquidation Day and the credit spread flowing out and SPY falling, as well as Nikkei and DAX index falling substantially in early April, they've been able to reshuffle their chessboard and make the best moves that they can given the circumstances. The issue, comes when you start to visualize the long-term problems that are still plaguing the U.S., right? Although we can, again, restructure some things within the global monetary system, like reshore some industrial manufacturing or provide liquidity via dollar swap lines to these other central banks and then weaken the dollar substantially like we did in the Pause Accords in 1985. The long-term problems of the debt and the deficit are not solved. And even given Elon Musk's Doge project and, substantial pushes from Republicans and a few Democrats to reduce the deficits meaningfully, nothing has really been done. And the actual, accomplishment of that goal is much, much more difficult than most people realize, right? Because there's so many vested interests that have basically money that's being made from the government deficits. And so we don't solve the debt problem, even with rates here. We don't solve the deficit problem. We don't solve the eventual need for QE or for finding some other source of funding. And even if the Fed continues to do their stealth QE by, shifting issuance, or the Treasury can do the same thing, right? The Treasury can shift issuance from the long end to the short end and essentially provide quasi-stealth liquidity via that mechanism. Nothing fundamentally has been solved about the $37 trillion debt and the $1 trillion plus of interest expense we have every single year. And so that's the issue that I still see hurting the United States.
Yeah, that ain't being solved. There ain't no solution for that. I mean, there's a small chance potentially through some high inflation for a couple of years, like Lou Grumman talks about, maybe through super double-digit inflation for 3-4 years, we could bring the ratio of debt down potentially. And if some miracle with efficiency gains through AI, through Trump repealing, 20-30% of the regulations and unleashing the American economy, maybe we can make a dent in growing out of it a little bit. I don't see us making a lot of ground on that. So that's just kind of is what it is. It's like the modern medical system. Like, we'll just treat the symptom. We can't really cure it. Let's just manage the sickness kind of a thing. So in that frame, which we're both sort of agreeing then, really it comes down to the rate of degradation, like how bad does it get and how fast. But the direction that we're going is pretty set. So we have to think about then how do we protect ourselves, or I like to think about how do we make money through this, right? I know you like to talk about gold and Bitcoin, as do I. Two assets that are sort of not only outside of that financial system, but outside of any country as well. Maybe as lifeboats. How do you look at them in regards to the mechanics of this debt bubble that we're in?
Sure. So I've written several pieces about gold and Bitcoin and their correlation to global liquidity. And Michael Howell's also touched on this as well. There are several other macro analysts you can check out. But essentially what I found is that gold has been a pretty prescient front runner of global liquidity waves by about 12 to 18 months. And Bitcoin has been, unfortunately, a laggard, but obviously a much more extreme and volatile laggard in the sense that if gold will go up, let's say 10, 20%, Bitcoin can go up 60%, 70%, just because of the nature of its electronic means of payment, as well as obviously its smaller market cap. But gold and Bitcoin have worked to hedge against debasement and against inflation for decades. And of course, gold has been theorized to be suppressed. And I think that there's credence to that claim. That's been suppressed by central banks and by bullion banks for the last 20, 30 years, but that suppression is finally coming to an end. And the reason why it's coming to an end is something I talked about in a podcast in March, as well as a written piece in February. But what I essentially was getting at was, if you look at the COMEX and the physical orders and the physical deliveries that are now being made, it's starting to reach epic proportions, right? Even rivaling what we saw during 2020 in March during the COVID-19 shutdown and the massive withdrawal of liquidity from the global banking system. So the question now becomes, right, who is doing this? Who is drawing this liquidity? And who is drawing this physical gold out of the system? And who is trying to front run it, what they view, in my opinion, as a new global liquidity wave? And I think that is mainly the Chinese and now the Americans. If you look at the physical gold orders from Shanghai, from the Shanghai Gold Exchange, they've been very, very consistently showing an increased appetite for gold ever since 2022, and especially a delta in the difference between the Shanghai physical gold rate, which is their cash, basically like their spot market for physical gold, and the COMEX. You see like a $50, $60, $70 delta open up at some times. And so that allows traders to arbitrage the trade between those two nations. And so that was responsible for the first leg of gold appreciation from, let's say, 2022 to late 2023, mid 2024. And that shifted obviously especially once Trump took office. We saw a massive amount of gold deliveries and what I believe to be a rush of physical redemptions for Fort Knox. Now, again, this isn't confirmed because the government won't release this data, but according to StoneX, which is one of the exchanges in the LBMA and one of the market makers that settles physical gold trades, they found that there was around 700 tons of physical gold that was shipped from London to the United States in the 2 months of January and February of this year. Now, the official import numbers are for 1,300 tons. So that means that, if we shipped in if they declared 700 tons shipped to the COMEX, and then there was 1,300 tons total, where's that other 800 tons going? And a move of that size, obviously, is in 2 months what the U.S. would normally import in a year or 2 years. And so it's a huge move. And the only type of gold that doesn't have to get outright claimed on our import-export numbers is what's called monetary gold. So this is gold in 400-ounce bars. And so that monetary gold would only really be going to one place, and that's Fort Knox. And so again, you just use the A plus B equals C. Rationalization is that the U.S. is now starting to, I guess you could call it, reshore or call in its gold reserves, and basically called a bluff on the LBMA and on the Bank of England on their paper gold certificates that they've sent out. And so that's why the lease rates in London exploded in January and February. That's why we saw massive gold backlogs, redemption backlogs at the Bank of England. And that's probably why they don't want to do the audit just yet, even though Elon Musk and Trump have talked about auditing the gold reserves at Fort Knox. It's because they're still waiting to refill all of the empty vaults with physical gold, because right now what they have is mostly IOUs in there.
It's an interesting theory. We'll see how that shakes out. I did a video talking about this. Number one, obviously that talk got really big about why don't we audit it, which seems so simple. Like, why don't we audit it? But then they're like, of course we audit it. It happens all the time. Mm-hmm. It's just not public. So I don't know. We'll see about that. But I also talked about in a video that potentially, what if we found out there was more gold in Fort Knox? Then that could be equally as bad, if not even worse. Because
why do you say that?
I would say it'd be worse because what if we had more gold in Fort Knox than we thought we had? So then why would the U.S. be buying more gold? They're preparing for some sort of currency collapse that they're trying to shore up. What do they know that we don't know? Should we be shoring up our currency, right? I would think it would signal a weaker standpoint. I think the U.S. could argue why it doesn't have gold. I mean, Canada has no gold, right? Like the U.S. could argue getting rid of some of the gold. Oh, we have it on loan, whatever. But having more gold almost seems like it could be worse. Like, oh, if the U.S. thinks their currency is going to collapse, so they're buying more gold, maybe we should. So I thought that was an interesting caveat. But yeah, we don't really know. I did see last night breaking news. I haven't been able to find out if it's true or not, so I didn't want to talk about it publicly. But you probably had seen it. talk of China and Saudi opening up a gold-settled oil window. I don't know if you saw that yesterday.
No, I didn't.
So that's big news. I haven't been able to really verify that. I've seen it from a few people talking about it. But yeah, potentially having gold and oil settled by China and Saudi Arabia could be a pretty big deal. What about the Bitcoin piece?
Sure. So Bitcoin, right, it has been trading as this, I guess you could call it like levered proxy for global liquidity for the last, let's say, 3-4 years. And really, this is not new or just unique to just Bitcoin. Again, gold trades, although at a different time scale, meaning like I said, gold will front run the liquidity waves and the contractions. And the S&P 500 and QQQ also are very, very close in their correlations to global liquidity. If you stack a chart of global money supply or global central bank balance sheets, minus obviously the TGA and the reverse repo window, and then you compare that to the SPY, it's like a 0.88 correlation, which in finance, of course, is extremely strong. So it's not just obviously Bitcoin that's been sensitive to global liquidity. It's literally every single financial asset, especially in the US. But Bitcoin has been trading in this kind of like quasi range here and, between 70 and 90 for the last few months. And I think that that's indicative of where we are in the global liquidity cycle, right? The Fed began their taper just a few years ago, and they've continued their taper, albeit at a slower rate. And then we found out, like I said earlier, that they've been really just tapering the short bonds, not anything past 10 years, which means that on net, the liquidity drain on the system isn't as bad. And now they've entered this area where they're kind of in a limbo, right? Just like with other cycles, they aren't set on cutting the rates to zero yet, and they aren't set on doing QE yet, but they also aren't telegraphing that they're going to hike rates anytime soon or keep them here for the next 3 or 4 years. There is a plan to slowly reduce interest rates. So because of that, Bitcoin has been also in limbo as well, because global liquidity is kind of in this doldrums. Bitcoin's been in these doldrums as well, and we probably won't see a breakout above 120K until we see major easing by at least one of the large global central banks.
Well, you mentioned Michael Howell yesterday. I'm on his newsletter. Or not yesterday. You mentioned Michael Howell earlier. Yesterday on his newsletter, he put out that global liquidity hit a new record all-time high, and it's been on the uptrend. And he said that he actually changed his forecast. He thought that global liquidity would peak out Q4 2025 because it runs on these 5-year cycles, he calls it. But now, because of what's happening with the major central banks, he thinks it's going to go well into 2026. So we have seen global liquidity taking off quite a bit. Just seems like the U.S. hasn't quite jumped on board with it, maybe.
Sure, but even that still, doesn't take into account the lag, right? Like if you've seen the chart of the global M2 and Bitcoin,
like a 3-month
still
lag.
It still lags by quite a few months. Yeah. And of course, like we said, Bitcoin is is sensitive to global liquidity, but there's obviously a lot of caveats, right? There's the moment-to-moment reshuffling of debt. There's the refinancing of the treasury bonds. There's the tariff wars, right? And what banks and corporations are going to do with regards to their currency reserves in those cases. So it's not a simple picture, right? That's why when people ask me like, what's the fundamental benchmark of global liquidity? What is it? Like, tell me one number. It's very difficult to quantify.
Well, it's not one
because
number.
There's so many. It's not one number, first of all.
Yeah.
But it's like, if they change the SLR, for example, and exempt treasuries from being in the leverage ratio, that would change how liquidity flows throughout the system.
Sure.
But it wouldn't come up on any screen. You wouldn't see the number of Michael Howell's calculation change. That would just be a regulatory change.
Right.
And so those kinds of esoteric or abstract impacts are hard to quantify and hard to parse out. So. And again, remember, it's a strong correlation. It's not a perfect correlation. Doesn't mean that tick for tick, where global liquidity goes, Bitcoin goes that single day. There's still obviously a market for it.
I like Michael Howell's model. I like the Bitcoin layers model. I think Real Vision has a good model. Those are the kind of the three that I look at, and they're all kind of tracking pretty similar. I want to wrap this up, and so let's just let me throw you an easy one here. Dig into your crystal ball, but polish that thing up. And I'm going to give you a layup here, though. But do you think we end 2025 higher than we are now?
In the Bitcoin price?
In, let's just say, markets overall.
Yeah.
Gold, S&P 500, and Bitcoin.
Yes, all three. Yes to all three. And again, the reason why is because the fundamental factors that are pushing all three higher haven't changed, right? We're still looking at, potentially, like you said, higher global liquidity in the coming few years, and especially by the end of the year. We're still seeing the carry trade impacts and the dollar recycling impacts of Triffin's dilemma, pushing U.S. dollars back into U.S. equity markets. And, debasement is still inevitable given the current U.S. debt levels and the fiscal situation. So because of those three reasons, I don't see any strong argument as to why at least, or even one of those three should be lower. I think all three are going to be higher substantially. So, and I think gold, especially, like I said, is telling of more inflation coming in the future in 12 to 18 months, just because it's been such a good predictor in the past of coming inflation waves.
Yeah. Perfect. All right. I'm going to wrap it up with that. Thanks for joining. You really laid the whole sort of global chessboard out very well. And I agree with you on the sort of inevitability of where we're at least for the foreseen future here. I want to link down in the show notes down below. You have the Dollar Endgame, your newsletter that you write, which is great.
Yep.
So we'll link to that down below, and your Twitter handle. Anything else that you want to call out for everybody to go check out?
I have a YouTube channel as well. I talk about markets, talk about gold, Bitcoin, commodities, equities, obviously. So that's just at Peruvian Bull. So you can check that out as well.
Yep. We'll link to that down below. Thanks for jumping on.
Sweet. Thanks for having me.